Intel. So Intel develops a broad range of SIMs, so gaming, storage, connectivity, as well as SIMs used for autonomous systems, as well as a foundry business that manufactures semis for other semi companies, same as Taiwan Semi. However, this business of Intel, the foundry business, has been absolutely decimated by Taiwan Semi. It also provides software needed to make semis. Okay, let's get into Intel. The net income margin has performed well, relatively stable. It's above the industry average of about 80%. Okay, just one more thing about Intel. Intel, Taiwan Semi just manufactures semis. It is a pure foundry. It just makes the semis for uh, other semi companies. Intel not only so Taiwan Semi does not develop semis. It just makes Intel, in addition to making the semi, it also designs and develops. So it has another arm of its business that Taiwan Semi does. So Intel competes on a wide range, whereas Taiwan Semi is specifically specialized in just making semi foundry business. Intel is a foundry business, but also designs and develops its own semi. Just wanted you to have that bit of background. You will see why it's important as we go through the analysis. Okay, so we talked about the stability of the net income margin, the fact that it is above the industry average. Now the margin, their good performance can to a degree be basically explained by good cost control. You look at the cost of revenue. You look at the cost of revenue as well as the cost of revenue. Yes, it has popped from 2019, but still, you know, basically it's reached 2018 levels. So pretty much stable expenditure there. R&D is not really increasing R&D by that much. So very, 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 very tight cost control. Costs are being kept on a leash, and that has resulted in pretty stable margins. So stable costs will obviously result in stable margins. So revenues, however, are not really growing at an explosive rate. They are, however, in line with industry average. Industry average is about 6%, so growing on average in line with industry average, but not much to really write home about. So you understand why costs are kept on a tight leash just to protect profitability. So R&D as a percentage of revenue is very stable at an average of about 18%, slightly below the industry average, about 20%. However, in my view, I feel like this should be a bit higher, considering that Intel has lost ground in many of its competitors, not just Taiwan Semi, but also other developers and designers of Semi. Just lost ground on all sides. It's a company that is under siege, so I would expect it to really be aggressive in growing R&D. Okay, so now growth in revs, like we said, really lackluster. Not much to write home about there. Revenue growth, then not necessarily mediocre, just not what you would expect considering the market is growing at such a fast pace and the business and the assets that Intel has. You'd expect revenue to be a good high in years. I mean, it's in line with industry average. I mean, that's decent, but you'd expect more considering what Intel is, and where it should be. But anyway, so so revs, they're not necessarily mediocre. They're just really uninspiring, and that uninspiring revenue growth can basically be explained by Intel's strategic blunders in the fact that it didn't pursue certain markets. For example, producing semis for mobile phones. It didn't aggressively pursue it. it wasn't really productive in developing next gen semi. It just made a lot of strategic blunders. The net income growth again lackluster. Nothing really to write home about. Lackluster, but it does follow very uninspiring. The ROE, however, is above the industry average, about 26%. So the return on equity on average about 31%, above industry average of 26%. But this is understandable, as you know, Intel is a well-run company. It just lost its strategic vision, about half a decade to half a dozen years ago. So, looking at, the margins, looking at these matrices. So from a financial point of view, Intel is a very solidly well-run company. It is. The problem with it is a strategic vision. It has allowed competitors basically to gain and steal market share from all business segments, as you can see by the really lackluster performance. But it is a well-run company. Just lost the strategic edge. The financial position, however, current ratio below the industry average, 2.37. However, looking at the level it is at, there's no heightened increase in short-term liquidity risk. Intel does have enough short-term liquidity on its balance sheet. The asset test, same as with the current ratio, below the industry average, which average for that is about 1.88. But looking at its level again doesn't indicate the heightened increase in liquidity risk. So even though there has been underperformance in the asset test and the current ratio, Intel is still in a good solid liquid position. Short-term assets as well as liquid assets are enough to cover current liability. The good thing about Intel is that it has well over 5.8 billion in cash, so in a pretty decent, liquidity point of view. The inventory days have, however, outperformed the industry average. At an average of just over 98 days, the industry average is 101 days, so it's very impressive. And it goes on, highlighting the fact that Intel is still in a good liquid position. Doesn't hold stock, doesn't hold inventory for longer than it needs to, especially when compared to the industry average. So that's very good. So it doesn't have the balance sheet is not burdened by illiquid assets, which are inventory, doesn't hold inventory for that long. As well as margins aren't burdened by increase in holding costs. Because the more stock you hold, the more holding costs you're probably going to have to incur. So good asset management, and all this good asset management just basically highlights a decently liquid financial statement, a decently liquid balance sheet. The debt to equity is very respectable. At 79% on average, it's below the industry average of 126%, which is good. It indicates that Intel still has a lot of additional room to add debt without really wrecking the balance sheet and adding too much risk. So it does have a low debt level, makes it very risky, makes it very less risky and very attractive, as well as it will need this attractive balance sheet, basically just start clawing back some much lost market share. All right, so the cash position. The cash margin, again, very impressive at an average of 44% above the industry average of 32%. And again, it's very stable, good indicator of a mature business model, as well as an entity in Intel that can generate revenue from its operations. I mean, in 2020, 45% of its revenue turned into cash. So that is that is very good. That is really really good. Percentage of cash flow fairly stable. A lot of cash. Does ever go into the returning share? Yeah. goes into returns to shareholders. It is slightly above the industry average. What is sufficient cash flow? So sufficient cash flow is 0.86. That's on average, and the industry average is 0.84. So it's slightly above industry average. Good performer, a decent performance. It's also a very good indicator that Intel is in a strong cash flow position with enough cash generated from operations to fund all necessary operations. Now, since a lot of available cash goes to shareholders, an indication that Intel makes use of cash to reward shareholders and being effective with cash and just holding it on the bank, so they burn holes in the balance sheet. Now, the industry average of return to shareholders is around about 46%. Intel's average is 56%. So even though, even if Intel can cut its, its returns to shareholders, I mean, the stock will get hammered, it will get punished. But even if it can cut that, just to boost its available cash on hand, just to boost the face of cash. I mean, sufficient cash flow is still very good. It's still decent. It's outperforming the market. But Intel has lost so much market share that it needs a very, 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 very large war chest to go up and close that. But it's not going to be really not going to be easy. So, you know, it's good. I mean, look, the return is good. The the margins are good. The sufficient cash flow is very good. Returns are excellent. But you know, you get a feeling something must give with Intel. I mean, its PE is at 9, which is just laughable. For me, Intel, I mean, it's a well-run company. Problem is, the strategic vision just let it down a bit. And I think once Intel can just get a hold of the strategic vision, just basically reinvent itself, I would stay away from it. I really would because um, projections do indicate that Intel is really going to struggle in clawing back market share. It's behind almost each and every single competitor. So it still has a long way to go. But for me, nah,